So you're seeing companies like the ones I just mentioned that are all taking kind of a pretty good beating over the last 6 months or so. And you're also seeing every single day the NASDAQ is experiencing a new high 9 days in a row. So you got other parts of the market that are going to the moon, but then you got other parts that are falling back to earth hard, big time. So you're starting to see these huge swings in the market. And one of the things that Andrew and I were talking about earlier today was these are signs that we might be on the other side of the mountain here. And when you start seeing wild swings in the market of companies and prices, 27% down, 44% down for a company called Chegg, which is an education company, 2 days ago was down 44% in one day. Those are not normal. When they have to stop trading on a company like that, I think it was 3 or 4 times because it was hitting the breakers that are set for these automatic downs. When you start seeing stuff like that, that's not normal. And that indicates that that people are trying to get out of these trades because they realize that they're not good investments for them. So I guess what are your thoughts on some of these things I'm talking about?
It is very interesting, like you said, where you have the dichotomy of certain growth companies. A lot of them, you can correct me if I'm wrong because I don't follow these names very closely, but a lot of them don't make profits. A lot of them just really play that whole let me try to grow my sales as fast as possible
Mhm.
and still burn a lot of cash. On the flip side, you have some of the more kind of, I put in air quotes, traditional growth names like the FANG stocks, the big tech stocks.
Mhm.
These stocks, which actually have earnings and cash flows, are also growing at very high rates, but they're not seeing their share prices crash. I mean, Facebook had a little bit of, they had like a little bump, when they were going through some turbulence last week, but it's not like these huge gashes that some of the names you're talking about are seeing here. And I think whatever side of the mountain we're on, whatever a mountain really is, as investors, you can prepare to be amazed. Whatever you expect the future to look like, it might not look like what you think. And so we could very much be on the other side of a mountain that rhymes with a lot of different cycles we've seen, or we could very well see stocks like this continue to crash while other stocks continue to do well. Like there's nothing to say. If I look at the earnings of a lot of great companies right now, something like 70 or 80% of them are beating earnings expectations.
Mhm.
The economy seems to be humming along really, really well. These companies are flush with cash. There's cash everywhere. And so it's very possible that you continue to see these falling stars, if you will, while
Mhm.
at the same time the rest of the world goes on and does very, very well. There's several factors to that, but I really don't want to run over the fact that to buy the dip on these, I mean, that's a scary proposition because if you talked about like Zillow as an example, I don't have the exact numbers, but it was something like they went down 20% and then they went down another 35%. So
Mhm.
these are huge numbers. I mean, they might not sound big, but take like a 70% drawdown, like you mentioned. If you have a stock that you bought and it lost 70% of its value, you have to more than triple your money from there just to break even, more than triple. So even let's say, we weren't that bad. Let's say we lost 50% on like Fiverr or something. You lost 50% on that company, you'd have to double just to break even.
Wow.
If we look at like the history of the stock market, the average is somewhere like 10% a year. So by the way, to get to double would be 100%. So you're talking about 10 years of average returns to get back to a double, and you lost that amount of money in like a week or two, right?
Mhm. Yeah.
So that's a very scary thing. And that's why I think it's important not to take these lightly and not to think, ooh, maybe there's value here, because there's a reason why a lot of these companies fell a lot and they could fall a lot more. And that could be devastating. We could talk about wiping off years of compounding, and that's why you stay away from expensive companies.
Yeah, that's exactly why. And it also highlights what Andrew was talking about, the fundamentals of the company, of these companies. Some of them weren't all that great, but because of the nature of so many different psychological ideas and how we think about things, a lot of these companies were bid up that really had no right to it. And again, I'm not trying to bash on the companies. I want us to think about the choices that we make when we invest in different companies. And you look at a company like Google, for example, the company is the third or fourth largest company in the United States by market cap, is monstrously huge. And that company is still growing revenues at 30, 40, 50% quarter over quarter, year over year right now. And like Andrew was saying, it's beyond flush with cash. And this is not an endorsement to go out and buy Google, but you have to think about each individual company on its own. And you can't make generalities and say that because three or four other companies are falling, that the whole market is going bad or the economy is going bad. A lot of times, these situations are islands upon themselves, and you have to think about them, I guess, in solo focus. And you can't compare Peloton's results to Microsoft's results, even though they're both air quote growth companies. The way that both businesses are operating and just the basic function of what they do and how they're doing it and how they're being run are vastly different. And so the results that you see in the market, it doesn't always equate. So I'm going to go back to our friend Benjamin Graham and Warren Buffett. So both of them have kind of stated this maybe in different ways, but in the short term, the stock market is a voting machine. Ergo, a company like Peloton or Pinterest or Zoom. So people voted on those and bid them up huge because of how they anticipated the companies would do. But in the long run, the stock market is a weighing machine. And that means that over time, over a longer period of time, more than 6 months or more than just a year, the market is going to reward companies that are performing on their business merits, not on whatever the shiny new object is. And there's always going to be a shiny new object. It doesn't matter. It doesn't matter if it's 1950 or if it's 2020. There's always been shiny objects, and there always will be. And it's part of the fun, and it's also part of the challenge of investing in the stock market. Is you have to learn to discern between the two and decide what kind of investor you want to be. And one of the challenges to investing in the voting company types of companies is you have to know when to get out, because if you don't, then you're going to be one of those people sitting on that 70% loss of a company like a Peloton. And I know that if I bought it and I lost 70% of my value, let's say, I think it was trading, I looked earlier, it was trading at its high around 160 some bucks a share. Don't hold my feet to the fire. Imagine if you were if you were an investor and you bought it at 155 and now it's sitting at 60. That'd be a horrible feeling. I would not wish that on anybody. That would just be a terrible, terrible feeling. Because now you got two choices. Now you have the choice of, do I sell what I got left and just take the loss? Or do I hang on to it hoping that it'll get back to where it was one day? But like Andrew was saying, a 50% loss means that you have to double. So you have to you have to get back 100% of where it was. And that's just to break even at 50% loss. At a 60 or 70% loss, you're talking about a triple. And if it couldn't triple in the prime market conditions for a company like that to succeed, it's not going to do it now.